performance is not a guarantee or a reliable indicator of future results. Investment is risky. Capital preservation and risk management is key. Joining us to discuss the risky business is Anthony Smouha. Welcome.
Thank you.
So the current climate is on the verge of crisis in some economies and interest rates are remaining low. So what about individuals? Will they get financial security?
Yes, I think we can get financial security as individuals, but it is much more difficult. In the past, an individual could just put his money into government bonds or very good quality corporate bonds and get a good return for either his current needs, or if he was in retirement, he could get a return above the level of inflation and giving a certain percentage return. At the moment, however, the world is in a period of very low growth, and particularly in Europe and particularly in Switzerland, a period of almost deflation. And as a result of that, the governments have chosen, in a sense, to penalize savers from having very safe returns in the safest of instruments. So one has to be a lot more smart about the way one goes about investments. So obviously it is clear that if one is an individual, that one has one's properties, and if one has one's properties, one can get a good rent, and that rent will provide a return which will be very satisfactory. The other area in which one can get returns is equities, but equities have a level of risk. Some equities are very safe and blue chip equities and have done very well, as we can see in the equities of Roche and Novartis this year, when one has made not only a decent dividend yield but also very good capital returns. Our area is slightly different. Our area is in the fixed interest world, where one can get good returns despite the fact that government interest rates and high quality corporate interest rates are very low. And that is what we're doing, is we're buying junior debt of quality companies, particularly in a way financial companies. And as long as the financial companies, which are sometimes very large banks, very large insurance companies, very good quality companies, which are being forced to become safer by the regulators, as long as they stay alive, they will pay the interest rates. And the junior debt of these companies can sometimes give 4, 5, 6 or 7% returns. And that is where one can get very safe returns. And our job is to select the safe companies, the best instruments to protect the investors, and we do that through a diversified portfolio in funds.
Oh, great. And taking more risks seems to be a bit more popular these days. Are you talking about using your safe bets? Are there any other safe opportunities?
I think that one always has to balance one's risks. In equities, always have a level of risk. Even blue chip equities have a level of risk attached to them. Even if one buys a Roche or a Novartis, which are very safe companies, very good companies, one has to be prepared that the share price can fall in periods of crisis and one can lose 10 or 15%. If one holds them for the long term and one holds them for the dividends, that is a good thing, and one does not bother about the volatility of these investments. Our investments in the bond area are slightly different in the sense that we're relying on the coupon, we're trying to get good value, and we're not worried about whether the earnings are going up or down. We're only concerned about whether the company stays alive. So if we take an example of a Lloyds Bank or a Barclays Bank or a UBS or a Credit Suisse, as long as they stay alive and as long as they're able to pay stock dividends, they will continue to pay the junior debt. And in that case, in the junior debt of these companies, one will continue to get one's coupons. And these coupons can be 4, 5, 6%, as I mentioned before, which gives one a return commensurate with the return versus inflation that one has. And that is a good return for individuals and for retirees and so on.
Well, thank you. So predicting the economic future is almost impossible. What can investors do now to help themselves?
I think investors need always not to put their eggs in one basket. So the investors have to put put their investments in different categories, as I mentioned before, properties, equities, and fixed interest. We do not think that government bond yields, particularly long-term government bonds or high corporate bonds, are safe places, because if interest rates go up, the investments may be safe, you may get your money back, but in the short term one could lose a lot of money. So what we're trying to do is to capture high yields in the investments that we have of these companies, which are very safe companies, but where as a result of them needing to issue junior debt, we buy that junior debt, which sometimes requires a lot of sophistication. We do, and that is the reason why the ideal way to do it is through the funds, because you have a diversified portfolio of different investments which give a much better yield. In addition to that, I think that interest rates eventually will go up. And in our portfolio of investments, we have selected bonds which have a floating rate note. And this floating rate note means that at the moment, while we're getting very low interest rates, and while the companies may be top quality insurance companies like AXA, for example, the floating rate notes are priced at a very low level and based on 10-year yields. They're priced in the 70% range. That is undervalued, in my view, on a long-term basis. So over the long term, not only will we expect to get the higher yields, at the moment we're still getting a margin over 10-year yields, which is much better than a normal bond, but eventually we would also expect to get capital gain.
Well, great. Thank you so much for coming in to explain all that with us. The bond market is something that keeps on changing, so make sure you keep checking back with Dukascopy TV for the latest news. Goodbye.